So what if I told you there's a retirement account where your money grows completely tax-free, it's tax-deferred, and when you take it out for retirement, it's tax-free income? You probably think that sounds too good to be true, but it's not. It's called the Roth IRA, and it's been around since 1997. So how did all this come to be? So in 1997, Senator Roth from Delaware went to Congress and said, we need a way for Americans to save after-tax money for retirement and allow that money to grow tax-free and have the distributions be tax-free. And that was passed in the Tax Relief Act of 1997. And honestly, it's one of the best retirement vehicles for Americans to date. It's been around since 1997, but I feel it's just now become popular. It's popular with young people, it's popular in 401k plans, and it's all over the internet. So let's get into it. Okay, so here's the core mechanics of the Roth IRA. You're probably familiar with the traditional IRA and the traditional 401k, where you put the money in, that's a tax deduction for the year. The money grows tax deferred, but when you take the money out, it's all taxable, every penny. The Roth IRA kind of flips that. So you put the money in with after-tax dollars, money you've already paid tax on. That money grows tax deferred, but when you take it out at 59 and a half or older, all distributions are tax-free. So one thing we need to talk about is contribution limits. You can't just go put everything in a Roth IRA. In 2026, you can put $7,500 a year if you're under 50. If you're 50 or older, you get $1,100 catch-up contribution, bringing the total to $8,600 per year. It's indexed every year. It goes up a little bit. 10 years ago, it was around 5,000, and it's indexed for inflation. So we get a little bump every year as time goes on. So one thing people don't realize is if you make too much money, you can't contribute to a Roth IRA. So in 2026, if you're single, you can only make about $168,000, or you'll be completely phased out of a contribution for this year. If you're married filing jointly, you can make about $252,000 before you're completely phased out, which means you can't put in to your Roth IRA. A quick sidebar though, Roth 401ks have become very popular and there are no income limits. So if your employer offers a Roth 401k plan, 403b, 457, any of those, you can put in up to the maximum for the year without income limits. So that's a really cool vehicle that's out there. And as Roths become more popular, employers will start to jump on the bandwagon. And so most ones that we come across, they do have that option, even having in the thrift savings plan, TSP through the government, and most large corporations have already adopted the Roth 401k. So if you make too much money and a Roth 401k is not an option for you, you could consider Roth conversions. So Roth conversion allows you to convert existing IRA money. So all this pre-tax, traditional IRA, 401ks, all those, you can convert those to a Roth IRA and pay tax on the conversion amount. So for example, let's say you convert $100,000 from your IRA into a Roth. It's like you made an extra $100,000 this year. So that's taxable income. Let's say you're 24%. You give up about $22,000, $24,000 this year to taxes. The key, in my opinion, is to not pay the taxes with the conversion amount. So you would convert the full $100,000, then pay the taxes out of your savings, regular employment, checking account, that type of thing. Because that allows the $100,000 to compound versus only compounding $78,000 or so. So let's say you do convert $100,000 this year. You pay the taxes out of your checking savings account. That $100,000 is now invested in the Roth IRA. So over a 20-year period, say we make 7% on average return, that $100,000 is now going to be worth around $380,000 completely tax-free. So that's a lot better versus $380,000 that's taxable to you, where realistically you probably own about 80 or 75% of that account versus owning 100% of it. So conversions are a strategy, but not a blanket rule. Normally you would do conversions in a year where your income is lower because the Roth conversion amount would not push you into the next bracket. If your income is high, then it could push you into the next bracket, and then you really need to analyze and see, is it worth paying the tax now at the higher rate when you might be taking it out in retirement at a lower rate? Kind of a buy high, sell low scenario. Okay, so another option for you. It's called the backdoor Roth. Sounds illegal. It's not, I promise you. I do it myself. I do it for clients. And so if we go back to the beginning, I talked about IRAs and how when you put into the IRA, you get a tax deduction in that year. What you do is you still make that contribution, but there's a special form you can do with your CPA or tax preparer that says, I do not want a deduction for that contribution. Then you take that contribution and convert it to a Roth in that same year. What I like to do is I put it in one day, the next day I convert it. That way there's no growth on the account, because anything you do make during that period would be taxable. So let's say we put in $7,500, next day convert $7,500 to the Roth, then you can invest the money from that point. And so you can do this every year. There's a lot of caveats to it. Maybe we'll do a video on it and go over everything in detail, but that is an option for you that you can explore with your advisor or your tax preparer. One of the most common questions I get is, when should I do a Roth conversion, or should I do a Roth at all, and what age is most appropriate? So for younger people, it makes the most sense. Pay the tax now. You're gonna have 20, 30, 40 years of tax deferral, and that money will be tax-free. Regardless of what happens with tax code, which 30, 40 years, we have no idea what those numbers will be. But starting early is kind of my number one recommendation for younger people. Now, as you get closer to say 45, 50, or even older, it's something you need to consider, because most people in that age group are making the most money. They're higher earners, you're further along in your career, you've had promotions, so you're probably doing pretty well financially. So if you're paying the tax now at a higher rate, we need to evaluate whether taking it out in retirement at a lower rate makes the most sense. So for older people, I'm gonna go ahead and say people 50 or older, you're really gonna help your family when it comes to taxes, because the Roth IRA is tax-free even after death. And so you're gonna be prepaying the tax for your family members, and then once they inherit the money, they will receive it tax-free. The other cool thing about the Roth IRA is there's no required minimum distribution. So on traditional IRAs, 401ks, those types of vehicles, at 72-ish, 73 now, you have to take a required minimum distribution, which in the first year is about 3.6% of the account value, and it goes up as we get older. And the Roth IRA does not have that requirement because it's all tax-free. The IRS isn't gonna get anything out of it. The reason you have the RMD is because you received a tax deduction. That money is probably grown for 40, 50, maybe even 60 years, and the IRS has never received a penny of it. That's why they have that. They don't want people passing on money without paying taxes. That's just the reality. But the Roth IRA does not have that rule, and so that's a nice benefit. Which brings us to inherited Roth IRAs, or inherited IRAs in general. So this is for non-spousal beneficiaries. So spouses can inherit money, if you will, between each other and accept them as their own and continue on just as the previous owner. When you inherit money from, say, a parent, grandparent, aunt, uncle, anybody that's not your spouse, we fall into the inherited IRA rule, which came about in the Secure Act 2.0 a couple years ago, which says that all IRA assets have to be distributed over a 10-year period. And there's a lot of caveats to that. Hopefully we'll do a video just on those in the future. But just for this episode, we're gonna focus on the Roth IRA and the 10-year rule. So you have 10 years to take out this money. So if you inherit $100,000, you could take out about 10% a year and hopefully drain that account over the 10-year period. You could let it grow for the full 10 years and then take it all out. It doesn't really matter because it's tax-free. So let's compare that to inheriting a traditional IRA, where the income that you receive from the IRA during that 10-year period is taxable income to you. So you could be paying 22, 24, 26% on the money you're receiving over that 10-year period. And so some people won't defer the full 10 years because, let's use that example of 100,000. If it continues to grow and compound, maybe it's 150, maybe it's 175,000, and all of that would be taxable in that year. Whereas the Roth IRA, if it does grow to that larger amount, it's all tax-free at the end of the 10-year period. You just want to make sure you get all out over a 10-year period, or you will be penalized in that 11th year. So the Roth IRA can be a great estate planning tool if you're planning to leave money tax-free to your beneficiaries and to your family. And so I'm a big proponent of it. It's a great way to transfer wealth without worrying about taxes. Another alternative to the Roth IRA is a health savings account, or HSA. And I really like these because it's kind of a super Roth. It's a Roth alternative. It's something you can compare with other after-tax savings. And so the HSA allows you to contribute and take a deduction for your contributions, and then you can invest those contributions into the market. Those will grow tax deferred, and as long as you take them out for medical expenses, the distributions are tax-free. And we're all gonna have medical expenses and health care premiums in our life that you can use these for. And so I really see this as a super Roth IRA or a Roth alternative. Now the current limits for 2026 are $4,400 for single people and $8,400 for families. And so that's the max amount that you can contribute, and does not go towards the Roth IRA contribution limits. So you can put into this and the Roth at any given time throughout the year. The key here is that you invest the monies. You have to leave about $1,000, at least at most institutions, in cash to be used at any given time, but you can invest any amounts over that into index funds, mutual funds, anything that they have to offer. The other kind of caveat or requirement, if you will, is that you have to have a high deductible health plan. So you need to check with your employer or your insurance agent to see if you have a HSA eligible plan. That way you can contribute and open one of these. So let's bring it all together. So you make a Roth IRA contribution limit, $7,500 for the year if you're under 50. It grows tax deferred and is tax-free at retirement as long as you take it out after 59 and a half. It's been around since 1997, but it's really started to gain popularity, especially among young people. It's great for young people, great starting out. We never know what taxes will be, and it's just nice knowing you're gonna have some tax-free savings in retirement. It works for older people as long as you're not paying tax at the higher rate and taking out at the lower rate. It's great for transferring wealth. So if that's your goal, a Roth IRA might make sense in your later years. If you found this helpful, send me your comments at steven@jonesfinancialpartners.com. I read every single one of them. And if there's any topics you'd like us to dive a little deeper on, let me know. We'll make a video around it. We'll see you in the next video.